There is a number that decides if you can buy a house, a number that decides your car payment, a number that decides your apartment, your insurance premium, sometimes even your job offer. You didn't vote for it. You never signed up for it. And yet a small handful of private companies, not the government, created it, track it, and sell it back to you. Today, I'm going to show you the actual business behind your credit score, not the pay your bills on time advice you've heard 1,000 times, the money machine underneath it. Who profits every time you check your score? Who profits every time you get denied? And why the system is built exactly the way it is. Stick around, because by the end of this video, you'll understand your credit score better than most bankers do. First thing most people don't know, there is no single credit score. What you have is a product category sold by competing companies. In the United States, there are 3 major credit reporting companies. These are publicly traded, for-profit corporations, not government agencies, not nonprofits. Companies with shareholders and quarterly earnings calls, just like any other major corporation you could name. Each of these companies independently collects your financial history, your credit cards, your loans, your payment history, your addresses, from thousands of banks and lenders who report to them voluntarily. Then each company runs that data through a scoring formula, most commonly a model licensed from a separate, dominant scoring company that specializes purely in building the algorithm itself. That's why when people say, check your credit score, there technically isn't one single answer. You have a score from each of the 3 reporting companies, and they can all be slightly different because each one might have slightly different data on file about you. So right from the start, understand this. Your credit score isn't a government measurement of your character. It's a data product built by private companies, sold as a subscription and licensing service. Here's where it gets interesting. You'd think these companies make their money from people like you paying a monthly fee to check your score. And yes, that's one small revenue stream, but it's not the main one. The real money comes from 3 places. Number 1, selling your data to lenders. Every time you apply for a credit card, a car loan, or a mortgage, the lender pays the reporting company a fee to pull your report. Multiply that by hundreds of millions of credit applications every year in the US, and you start to see the scale. Number 2, selling trigger leads. When you apply for a mortgage, that application can trigger an alert that gets sold to other lenders, meaning other banks can buy the fact that you're shopping for a loan and start marketing to you immediately. This is a legal practice, and it's a big reason people get flooded with calls right after applying for a mortgage. Number 3, selling data and analytics to businesses far beyond lending. Insurance companies, landlords, employers doing background checks, even marketing firms who want to target people in certain credit tiers with certain offers. So, the business model isn't really help consumers build credit. The business model is collect data on consumers, then sell access to that data to anyone willing to pay for it. You are not really the customer of a credit reporting company. Now let's talk about the actual scoring formula that dominates the industry. The company behind this formula doesn't collect your data. It licenses its algorithm to the reporting companies and to lenders. Think of it less like a bank and more like a company that sells the recipe, while the reporting companies supply the ingredients. We do know the broad categories that go into this kind of score because the general framework has been made publicly available. Payment history, about 35%. Amounts owed, or credit utilization, about 30%. Length of credit history, about 15%. New credit inquiries, about 10%. Credit mix, about 10%. But the exact internal math, how those categories interact, the precise weighting is a trade secret. It is one of the most valuable proprietary algorithms in the entire financial industry, and the company that owns it has zero legal obligation to make it fully public. That matters because it means millions of Americans are being ranked, sorted, and priced by a formula they are legally not allowed to fully see. Here's the part that really changes how you see the whole system. A high credit score is good for you, but, and this is important, a spread of credit scores across the population is good for the industry. Think about it from a lender's perspective. If everyone had a perfect credit score, lenders couldn't charge different interest rates to different people. Risk-based pricing is one of the most profitable tools in consumer lending. Someone with a lower score might get a credit card with a much higher interest rate. Someone with a higher score might get a rate less than half of that. That gap, multiplied across hundreds of millions of borrowers, is enormous profit for the lending industry. So the credit scoring system isn't just measuring risk, it's actively enabling a business model where different people can legally be charged very different prices for the exact same product, based on a formula only a handful of companies fully understand. This is completely legal. It's disclosed in the fine print of every credit card and loan agreement in America, but almost nobody reads it that way. They think my score is low because I'm bad with money. Sometimes that's true, but the system is also designed structurally to make sure there's always a wide range of scores to price against. Now, let's follow the money one more layer. Because millions of Americans have low or damaged scores, an entire secondary industry exists just to help people fix or monitor them. Credit monitoring subscriptions, credit repair companies, credit builder loans, secured credit cards, specifically marketed to people trying to rebuild. Some of these services are genuinely useful and fully legitimate. For example, secured credit cards can legally and effectively help someone build history, and every American has a federally protected legal right to one free credit report per year from each major reporting company through the single official website authorized by federal law for that purpose. But it's worth noticing the pattern. The same data ecosystem that profits from selling your information to lenders also profits from selling you tools to manage the consequences of that same system. That's not illegal. It's just good business if you're the one running it. So, is this all rigged against the average person? Not entirely, because US law does give consumers real enforceable rights here. Under the Fair Credit Reporting Act, a federal consumer protection law, you are legally entitled to one free credit report per year from each of the three major reporting companies through the official federally authorized website, the right to dispute any inaccurate information on your report, and the company is legally required to investigate. The right to know why you were denied credit through what's called an adverse action notice. The right to freeze your credit report for free, which blocks new lenders from accessing it without your consent. That last one, a credit freeze, is one of the most underused tools in personal finance. It's free, it's legal, and it's one of the strongest protections against identity theft, because it stops anyone, including scammers, from opening new credit in your name without you personally lifting the freeze. On top of that law, the Fair Debt Collection Practices Act, an oversight from a federal consumer protection agency, exists specifically to hold lenders and reporting companies accountable when they break these rules, and there have been real, public enforcement actions taken against major reporting companies over the years for reporting errors and unauthorized data sharing. So the honest takeaway isn't the system is evil, give up. It's the system is a business, and businesses respond to leverage. Disputing errors, freezing your credit when you're not applying for anything, and checking your free reports regularly isn't just good advice. It's you actively using the legal tools built into the system to protect your own interests. Step back for a second. Your credit score was never designed as a moral report card. It's a risk pricing tool built by private companies, sold to lenders, and layered with a consumer-facing industry that profits on both sides, when your score is bad and when you try to fix it. None of that makes it something to fear. It makes it something to understand. Once you see it as a business system instead of a judgment of you as a person, you stop taking it personally, and you start using it strategically. Pay on time because it's leverage, not because a number is watching you. Keep your utilization low because it improves your pricing power, not because you're being graded. That shift, from the score judges me to the score is a business tool I can operate, is genuinely one of the most useful mental shifts in personal finance. If this video actually changed how you think about your credit score, do two things right now. First, go freeze your credit with all three major reporting companies. It takes about 10 minutes total, and it's completely free. Second, subscribe, because next week I'm breaking down the hidden business behind your car insurance premium, and trust me, that rabbit hole goes even deeper than this one. Drop a comment. What's your current credit score, and did anything in this video surprise you? I read every comment on these finance breakdowns.